The financial strategy that gets a business to $100,000 isn't the same one that gets it past $1 million. And most owners never switch. They run the same playbook they started with, pour more revenue into it, and can't figure out why the business feels harder to run the bigger it gets. I run the numbers on 34 service businesses for a living, and the pattern is always the same. Every stage has a different job. At 100 grand, the job is one thing. At 500, it's another. And past $1 million, it changes completely. And there's one band above even that, where fixing this stops being optional. So I'm going to walk you up the ladder, stage by stage, and tell you the one thing to actually focus on at each level. Start with the wrong one, and you build a business that gets bigger and poorer at the same time. At 100,000 in revenue, you are not optimizing anything yet. The job is to get the books, just to tell you the truth. Because right now, they certainly almost don't. At this size, most owners run the business out of their bank balance. Money in the account feels like profit, and it's not. You can make $50,000, $20,000, $10,000, and still not have profit in the bank account. You could have taken that money out the back of the business. You could have overshot the profitability, or you could have made a loss and then you just got paid again a second time that artificially increases what your bank balance looks like. So just because you think there's money in the bank account doesn't mean that there's more or less than the month before. It could purely be about timing. Timing allows a lot of things to kind of go underneath the radar if you aren't careful, especially if you're a business that has a good monthly recurring subscription. I've seen companies go all the way into the red, like substantially into the red, and still have money in the bank account just because of pure timing. This is really, really important at that stage. The other thing that can really help if you're not looking just to do your bookkeeping is use something like Profit First. Profit First is a banking system at its finest, and it's written by Mike McAllowitz. He kind of allows to use the envelope system, and that envelope system means that there's an income account where all your income comes in, and then you spread it out through different bank accounts so that you always make a certain amount of profit, and you know how much you should be taking from the business. At the $100,000 mark, this is the stage to get your pricing right before you scale any of the mistakes that you currently have. If you're underpricing at 100 grand, it becomes fairly rough to fix when you start moving up towards $1 million. Now, you can scale that, but what's going to happen is as you get to that $1 million mark, all of your legacy clients, if you have monthly recurring or people that buy all the time, you're still doing the same amount of work to those people. You just have so much more overhead people. You have so much more in the way of dues and subscriptions. You have so much more delivery costs. You have all these different things that you're now putting against these old customers who are legacy customers that aren't paying the same amount of money as what you should expect into the future. If your close rate is, well, let's say 50, 60%, we know that we have a pricing problem. So slowly start to raise your prices by 10, 15% with every new prospect that comes in. What's your close rate? If it goes between 30 and 40%, that's the perfect mark to allow you to know that we're in a good spot for pricing. And that will allow you to scale over time. And as you hire people, it will allow you to scale comfortably, because if you don't have money and profitability at $100,000, you're likely not going to have profitability at $3, $5, $10 million. I've seen it time and again. The companies that didn't have money at the lower levels didn't have money and or profitability at the higher levels. So next up is gross margin. This is really what's left from revenue after the direct cost of delivering the work as a percentage. So revenue minus the cost of delivery divided by revenue. Learn to read that one number now. You cannot manage what you can't see. Clean books and honest pricing are the foundation everything else in this video sits on. Get that right and you hit the next stage where the job stops being visibility and starts being margin. At $500,000, the job is margins. You have enough volume that a few points of margin is real money, and enough moving parts that the leaks are hiding. You should have probably an employee at this point and a couple of contractors. And so it's really important to understand that those are people that are going to be allocated to delivering the service that you provide. And the way that I read a healthy service business is 60, 15, 15. So 60% gross margin or 40% of your revenue towards delivery, 15% 15% to sales and marketing and 15% to overhead, which lands you near the 30% operating margin mark. And that is the shape that I'm always steering towards. When margins get tight, the instinct is always to cut expenses. And usually that's the wrong move. The route is almost always upstream. So if you're feeling like your margins are tight and you can see that, it's usually underpricing or delivery that isn't efficient, or the offer is packaged wrong. You can't cut your way out of a pricing problem, because if you need one full-time employee per $250,000, which is a good benchmark to use at this rate, can the other employee that you have, and can you yourself, and I like to use the employee because most business owners or founders, CEOs, owners, very good at delivering a product, can one full-time employee deliver $250,000 worth of revenue in a year, or $20,833 a month? If the answer is no, and your close rate is greater than 40%, we know we have a pricing problem. If you have a close rate of 30 to 40% or lower, we have an efficiency problem or a packaging problem. Likely we're offering too much service for pricing. So what we need to do is, rather than changing our price, we need to take away certain parts of that service. Okay, that will then tell you, okay, now if I was to take away this and this out of this package, can we do $20,833? If the answer is yes, you know that you fixed that problem, and it will allow you to kind of move through that. This is also the stage where cash starts to lie to you. You can be profitable on paper and still miss payroll because the money is tied up in work you have delivered and not yet collected. Growth eats cash. So it could be that you do accounts receivables or invoice people, and people are sweating you, and you've got 45-day terms or 30-day terms, and they pay you on 45 or 60. So you can have it so that that doesn't necessarily allow you to get that cash. In your mind, that's money coming in the door. But on your P&L and how things are actually working, you aren't there yet. The other thing to note is that most business owners don't know that their distributions, i.e. the money that they take from the bank account and move it into their own bank account. So it's a transfer between banks, or they might have used the business card for something personal. That's a distribution. That doesn't go on your profit and loss. That goes onto your balance sheet. And it's the cash coming out the back of your business. And it becomes super important at this size to make sure that you aren't taking too much in the way of distributions, because I have seen companies cannibalized by the owner's personal lifestyle. You want to just make sure that you aren't taking too much cash, because you can make $100,000 net income and take that $100,000 as cash from the back of the business, and you don't have to pay taxes on that, but you now don't have any cash in the business. So you can be in a position where that happens. Now, it's not always that extreme, but there are places where that can happen. At 100 grand, you are trying to see the business. At 500, you are trying to fix its shape so that when you pour more revenue in, more of it survives. As you scale, your pricing and packaging become one of the most important things that you can do. If you pour more fuel onto your marketing engine and you're already out of shape, you haven't got your pricing correct, you need more people and you aren't efficient, pouring more fuel on that fire means you're going to have to get admins faster. You're going to have to get more employees quicker. That's the biggest expense that you can have. And so to do that, it means then that you're going to scale that profitability down, because when you first hire someone, it takes 3, 4, 5, 6 months to be able to give them enough business so that they cover their salary and then start to make profit. They have a sunk cost. While it feels like they're taking work off of your plate, they're not necessarily, or they might be client facing where they're kind of running on their own, but there is an inherent sunk cost there. That means that you have to get them profitable out the back end. And so when you first hire them, it's like, hey, I'm coming up to 250,000. I'm absolutely slammed. I don't have any time left. All right, I got to hire. Well, now your profitability that went from $100,000 a year, and let's say we pay them $100,000. Well, now that $100,000 is utilized towards that person. So now you have to be at $350,000 to get back to that same level of profitability per se. So we're looking for those types of things. It's like, how do we make them profitable? But as you scale that and you have to hire more and more people, that problem compounds if you don't have your pricing and packaging and efficiencies there. So you've got to be careful. You are going to have those dips, and margin becomes the most important thing. Get the margins and the cash right, and now you're ready for the stage where the game changes. If you're sitting there realizing you couldn't tell me your gross margin right now, that's the normal starting point for almost everyone. And it's exactly the thing worth fixing before you scale. The way we find where a business is leaking profit is a short call we call a leak check. It's 20 minutes, we look under the hood, and we tell you where the money is actually going and roughly how much extra you're handing to the IRS. No commitment, it's built to be low friction. The link is right below this video. So past $1 million, everything changes. The business should be generating enough profit that the old questions get replaced by new ones. And the biggest one is usually tax. Most owners treat tax as a compliance job, something the accountant handles once a year. I read it as a cash flow lever. Instead of handing roughly 30 cents on the dollar to the IRS at year end, the move is to plan ahead and legally keep more of that cash on the table to redeploy into growth. Out there for a lot of business owners at this range, you're probably between 100 to 250,000 in net income. There are structures out there that allow you to get leverage. You put $1 in, you get $3, $5-ish of expense back. And usually they're tax equity investments and those types of things. So we are able to then start using these larger strategies where you can take 25,000 and write off a 5x multiple of that. The other thing to note is through the year, you should be starting to structure your lifestyle around certain structures. So you should be doing things like the Augusta strategy. You should be wrapping your weekend. I don't like strategies where I have to put $1 in and I will get a 30 cents discount. You should always be looking for leverage. A lot of CPAs out there say, well, go take that dollar and go put it into a 401k or a SEP or a profit sharing plan or a cash balance plan. But the reality is you've got to spend more cash to get your lower rate of taxes. And I don't really like that. Like, I do tax planning, and when I first did it, that was the thing that I didn't like. It doesn't get you cash savings. You're just taking money from the business and getting a discount on your taxes. It's structured different in the industry and the way that they speak about it, but I don't like that. It should be two things: leverage, and it should be lifestyle benefit, so that we can reduce your salary if done right, or reduce your distributions so that you can put it in your P&L as an expense, and then you're going to get quality of life. So we want to make sure that we're trying to find structures that give us leverage. Now, make sure that they've got audit protection and those types of things. It's super important. And this is not tax advice, but there are things out there that can help you. And again, this is general education. It's not tax advice. Tax is generally complicated and heavily regulated. So anything specific should get run past your own CPA. What I'm giving you is the strategy layer, way to think about it. Because again, we do tax planning. Each person is different. There's different situations. There's different risk tolerances. There's different ways that you want to be able to do this. But a couple of good ones is research the Augusta strategy, research wrapping the weekend, and research hiring your kids. That's a super easy way to be able to do it. This is also the stage, though, to stop running on gut and start steering by your numbers. A short stack of KPIs tied back to the 60-15-15 read, so you can see the bottleneck instead of guessing at it. It's like driving at 100 miles an hour with no lights and no dashboard. You don't know how fast you're going. You don't even know if you're about to come off the road. You can't see ahead to see if there's a turn. You can't see. And so making sure that you understand those KPIs or key performance indicators will help you. So gross margin is a key performance indicator. Close rate is a key performance indicator. Customer acquisition cost is a key performance indicator. Those are really, really easy ones to be able to track, and it will help you understand where the company is going. And honestly, this is where a smart owner starts caring about something new, and that's what the business is actually worth, not just what it earns, what someone would pay for it. This right here is a little bit of a mind shift for a lot of people, and this is where CFOs can kind of help. The business is supposed to be an asset, and an asset should have a return on investment, but it should also have time when you sell it. Now, you may not want to sell it. The same thing that you use to sell a business is the same thing you use to get out the day-to-day. But this is where you want to start thinking about, how do I position this company to be an asset where I am not tied in and it's not just a job? A business is usually valued as a multiple of its profit, and you get the profit healthy and predictable, and the whole thing is worth a multiple of every dollar you added. That's the difference between a job that pays you and an asset of your own. I've gone out and I've worked with companies that benchmarked 5,000 different companies. Most closely held companies will get a 2.76x multiple to a 3, okay? So if we know that that's the multiple, and we know that people are not wanting to buy a job, when you start getting to that million range, it's time to start thinking about the business as an asset. And it doesn't mean that we change the way that we're doing business. It doesn't mean that we go out and we hire someone to take our place and run it and do those types of things. It's just an understanding of, all right, we need to start positioning this as an asset that's going to help us eventually get to an exit or allow us to work minimally and take large amounts of cash. Go through our decision making, whether it's quarterly when we're having our company retreats or yearly, however it needs to be. We need to be thinking about those specifics, and that will help you over time. But having a value attached to what your business is worth, like let's say you're at 100,000 net and you're going to think that you get a 2.76. Well, you're only going to get $276,000 on that $1 million business, or 300,000. And look at how many hours you're working. Look at how much blood, sweat, and tears, the stress, the payroll, all of those types of things. It's probably not something where you want to be in a place of, hey, we're going to sell this. It's more around the thought process of how do we get it to a 6 to 10x multiple. And this is where the three things you built at the levels below, clean books, healthy margin, real cash, finally compound into that asset. And there is one more band above this, the one where all of this really stops being optional. Somewhere around the 2 to 20 in revenue, this all stops being optional. This is the range where the three numbers either work or they quietly sink you, and where I spend most of my time with business owners. At this size, the mistakes are expensive and they compound fast. A margin problem you could have fixed at 500 grand is now a 7-figure leak. The businesses that scale cleanly here are the ones that fix their shape on the way up, not the ones that just got bigger. I have two businesses. They've both been around the same amount of time. They've both been around for 4 years. Both been working with them for 3 years. One of the business owners has been stuck at $2.5 million. I've been asking him to get all of his sales and marketing data dialed in for that long. The other one is now at $35 million. The difference between these two business owners is this business owner doesn't want to track the right data and make sure that the data is clean. This business owner made sure all of the data was clean. And he was able to look at it, and we were able to find under the hood what caused the actual bottlenecks. And so because we were able to find the bottlenecks, we were able to get exponential gains over time. So it behooves everyone to look under the hood, make sure your data is clean. Sales, marketing, operations, and finance data all actually play together because a business is a living, breathing organism. And if you don't have your data, setting a revenue target when you don't know how many booked calls you need, how many, like what's your no-show rate, what your close rate to get to that revenue is basically throwing spaghetti at a wall. So make sure you understand all of your marketing and sales and operational data, finances as well, so that you can actually see where the bottleneck is, so you can fix the one thing that is going to get you exponential gains. And this is exactly the stage where owners tell me their revenue is growing, but somehow the business feels worse, tighter on cash, harder to run, less profitable per dollar. That is unit economics catching up with them. It's your company is growing, but your customer acquisition cost payback period is skewed. Your close rate is too high, so your pricing is not where it needs to be. We constantly have scope creep, and we aren't able to get our scope back in line with where it needs to be. All of these types of things, all of the problems that are hidden until you get to these larger levels start to come out very, very quickly, and you'll find that it's going to hurt you over time, and then you have to make changes, and as you're a bigger company, it takes longer to get those fixes enacted. And this is the proof that the whole ladder is real. Every stage below was really building towards a business that can actually handle this size. Notice that at every stage, the job was never make more money. At 100 grand, it was clean books and pricing. At 500, it was margins and cash. Past $1 million, it was tax and KPIs and enterprise value. None of those are revenue goals. They are all about the shape of your business, because more revenue never fixes a broken business. If the unit economics are broken, growth does not fix them. It accelerates the pain. You are just getting bigger and poorer at the same time. The owners who win are the ones who fix the shape first, then scale it. This is the exact path I walked myself through: bookkeeping, then tax, then CFO work. Then I built the business over time that was actually worth selling, one wall at a time. So for me, and my example is, I started off as a bookkeeping company and I wanted to add taxes to save people money. Tax prep never did that. We added tax planning over time, and then CFO services. We got it all dialed in. We worked out that the market fit was there, because product market fit is a really, really good thing. And so as we scaled that product market fit, it required us raising prices on old historical clients. It required us to understand what our unit economics were. It required us to know how much money to put into ad spend to make sure that we know what our customer acquisition cost is and how to get that customer acquisition cost paid back in 30 days. Because a customer acquisition cost that you can pay back in 30 days allows you to put it on a credit card and scale exponentially. And so it's really just understanding what levers you have in front of you and being able to pull on those to get it where it needs to be. Now, it's never going to be easy, but it is something that you can look at it and say, this is the thing that I need to fix today. And that's the ladder. At 100 grand, get your books clean and your pricing right. At 500, fix your margins and your cash. Past $1 million, treat tax as a lever, steer by your numbers, and build something worth selling. And through all of it, remember that more revenue never fixes a broken business. So the real move at every stage is to fix the shape. If you want us to actually look at where your business is on that ladder and what's leaking, that's what the leak check is for. The link below. And if you want to go one level deeper, watch this next one.